TGIF warriors. How's everyone doing? Good morning, Didier, Brandon, Sinatra, Alexander, Shahab. Hope everyone had a good week. Did Crude make your week? Alexander, how are you? Garav, you can hear me now. Hi, Shepard. Mark, how are you? Okay, so it's Friday. And Friday, I'd like to take a look at what kind of week we had. This gives me a bias going into next week. All right, well, Mark Williams, what's the most important word for a trader? One word. Take a guess. Anyone got one? Take a guess. The most important word for a trader. You could translate it to an athlete. No, Ziggy. No. Yeah. No. What's that in Hebrew, Amira? No. Next. Next. The only reason you look back is to evaluate what you did wrong, so you don't repeat it, what you did right, so you do it over again. But next is a very important word because a lot of people dwell. You guys dwell on a bad trade. I know it's not easy not to. Good for you, Alexander. As pros don't, they just move on to the next one. That's right. Okay. Every trade, here's where you want to get to win, lose, draw next. Okay. Just another trade. That's where you want to get to. If you get elated when you have a nice trade or a good week, you're setting yourself up to be deflated. So try and keep your balance. So looking at the euro for the week, we came off pretty good from that fib retrace that Blake pointed out up around 1360. And yeah, okay, nice. That was a nice rally to sell. I'll show it in a minute, Alexander. But if you look at these two weekly moving averages, the 50 and the 200, they're both real important. And I would say closes outside of either of them are going to give you the direction for pretty good magnitude of a move here. Okay. And why is this important right here? 10 and a half. I really think this 10 and a half to 110 level, if it's taken out, and look at this confluence here, 1040, and this was a breakout level. I remember for weeks, Steve saying that the euro has to get through 110 for it to be doing something constructive, and that's what it did. So you look at this, if we have equality, it may take it close to here. So I'm thinking that you probably have to buy this break, and maybe it won't even get here to accommodate people to buy the breakout. So that's the way that looks. And Alexander, that was a nice short on, you had a nice little failing rally in crude oil if you missed the initial break. I'd be careful if we start closing back above 39 and a half. That means there's more left. But that's going to be key in the euro, just like the dollar's in a similar situation. And the dollar doesn't look bad after the reversal week we had. We had some follow through. They really couldn't knock it down. And, I know a lot of people are looking for 92. I've had this line drawn for a while. I've had these speed lines drawn for a while. The big test is going to come in right around this 98.30 to 50 level right here, where we also have some convergence. I would say this is going to line up with the euro if it trades down towards 110 and a half. So, it's pretty much the same thing. we start breaking out over here, I think there's a very good chance for us to, you know, then break out and challenge the par level and par over par. You're going to blow through this. Okay. And if we fail, 92. So these are your two areas to look at for next week. Who does a lot of chart work and analysis over the weekend? And Saturdays happen to be one of my best days for looking ahead and prepare myself for the week ahead. Like I know I'm going to be gone for part of the week next week, but I know that I'd be looking for a shorting opportunity in gold if we got up into the 1784 to 1800 range on gold for next week. S&Ps, it's a down week, but it's also an inside week here. See, we're inside of last week's range. 30-30 was a breakdown. Maybe it does it late in the day. But I'd be looking for something if we take out this week's highs early and then begin to fade, that could be intraday. Um, Pretty much I'm watching things all day until I walk away or shut it down. I don't do a lot of set and forget, just not my personality. Okay, so yen is going to be important to the dollar story. It's about unchanged on the week. I know Steve says don't even consider trading it, but you know, we're putting in a decent candle here. Could just be a pullback before another push. And what else did I want to cover? I think that's mainly it. The key is going to be the euro because the dollar, even though FX has been a little bit non-eventful, it's still pretty important. Does the S&Ps rule over the dollar, or does the dollar rule over S&Ps? Also, um, rates, yields, they're all at crossroads. Look at TLT, it's bumping up right against major resistance here. So, see, you have a lot of setups where things can turn good or bad from this week's range, taking out the weekly range of uh, on the upside, and TLT should project it maybe up towards 170. I thought if this happens, I think mainly it's going to happen because of risk off. Okay, we'll see. I actually have Mike Larson with us today, who works with Weiss, and they do a lot on bonds. In fact, I read a book by Dr. Martin Weiss in the 70s that had a pretty large impact on me, and I'm going to discuss a scenario with Mike to see if Martin Weiss still thinks something like that could happen with as active as the Fed has been in bond markets. So that should be a pretty interesting interview. And Steve brought it up, and I brought it up as far as the gold is concerned. We made a new high, right? I mean, this high right here was a new high. And, I've always been a believer that the shares should lead. And, Newmont's not close to a high. We haven't even retraced 50%. So if gold gets a pop into the 80 range, maybe we rally to 61.8, but that would be kind of a bearish signal for gold that the miners are not making new highs with the bullion. So that's something to pay attention to. GDX has been stronger, almost retraced 78.6 of the decline, but that's come off to maybe we get to 36 if the gold has one more pretty good up day. I'm talking about $25 or so. USD CAD, I'll save that for the crew. Want to remind everyone to have a good week. It would help if you became part of our community. We've had a pretty good week. Greg is still long the gold, and Blake's still short WTI. and you could have been out shopping for a face mask, and you would have gotten a alert to take advantage of these trades, let alone all the great research you get from all the different guys that we have here, plus a different type of analysis. You get Elliott Wave. I follow Greg's stuff. You get Andre's stuff, harmonics. Andre's looking for 111.22. Okay, that kind of lines up, and there's his 110 level, the weekly level. So, and then you get all of Blake's and Steve's stuff, basic technical. Is what Blake is seeing here, kind of like a bull flag up at major resistance. This would imply, again, 111. He showed this yesterday, and then you get a breakout of a flag and a major downtrend. So, if you just look at it from here to here is 700 pips. And so if you get a breakout over this 113 level, that's why a lot of banks are talking 120 now. That would be a measured move towards 120. Any new members to our community this week? Raise your hand, or raise your hand if you want a discount and tell me which one. And we're only offering the discount today for 6 months and 1 year subscriptions. Anyone feel like investing in their own trading career? Okay. You could talk to Joe Perry about it, Alexander. I don't know if Joe is here. Yeah, but it's not for a 1 month deal, 6 months or a year. So you could email Joe Perry. Joe will work it out with you. Shahab, you too. There you go.
I
All
think
right.
Joe's traveling right now.
Oh, well, he just put up his email
Oh,
in
okay. Oh,
chat.
maybe he isn't. Okay. Well, I
Yeah.
wasn't sure. All right.
Anyway, we have some people that are interested in that offer, Joe. So I didn't know you're traveling, or I still would have done this. Okay. We may, depends if I get the green light from the owners of the company. Okay. All right. So now, yeah, you could get it now. Get a hold of Joe. And Blake, TGIF, buddy, nice work this
Yes.
week. Um, I know you helped me. So if you help me, help everyone listening to us all week long.
Oh, that's great. I'm glad that that worked out. It's interesting. I was just talking about crude a little earlier to the guys and gals in the chat room. I was hoping that we would, see lows. Now I really want to add to some short exposure here because it's trading pretty weak. So as long as it continues to trade weak, there's a few things that I want to do. So let's talk about some currencies here.
Take it away.
First and foremost, let's talk about the dollar Canadian. So the dollar Canadian is like and let me take a step back and say that the FX market has been extremely slow all night. It hasn't really done a whole lot, but the one thing that has happened is you see this dollar Canadian's holding up really well. We've been monitoring this big downsloping channel, and this was our chart of the day yesterday. So if you follow the chart of the day, was it yesterday? I have to figure
Yeah, it
that out.
was. It was.
It was
Like,
okay. All
yeah.
right. Let me just. I was just need to make sure that that was chart of the day
They kind of
yesterday.
blur together, don't they?
They do. For me, especially when I'm doing all these things. Yeah, it does. So anyway, so this is the chart of the day, and I do think that we're going to challenge the 137 level, and we're actually up against resistance right now. So you got to think about that as we're heading into Friday. Chances of us breaking out right now, it could happen, especially with crude oil weak like it is, and crude is between crude oil and the stock market, that could be the culprit that drives the dollar Canadian up towards 137. But I think the 137, you know, 10, 20 level is going to be channel resistance. It's going to be big. And if this breaks, then this is what I'm looking for. Okay, let's do this. So then, you know, we're looking for a move, you know, 137.40. My assumption is that would give anyway. So this is you know, to me, a more of a given through the 127% extension. Then you have to target 138 immediately. So that's where this comes into play. Now, is that going to happen today? I don't know if it's going to happen today, but it could happen today. You know, if stocks continue to weaken here, you know, it is entirely possible that we can continue to see, you know, Canadian currency weakness. I mean, it's, you know, with crude oil looking the way it is, with the stock market trading heavy, it's entirely possible. And you can see we're pushing up against what I consider, you know, pretty key resistance here. So if we clear, let's just say we clear um, the 136.65 level, then you guys got to be on the lookout for a break into new highs. It's interesting. The guys can't hear me in my office because I have them on mute, and I'm talking to you all, but I can hear them talking about the dollar Canadian actually as we're talking about it right now. Just, you know, talking about basically the same thing that, you know, and these are you know, traders in the New York area that I trade with. Anyway, this is something, and it's really the thing that's been on my radar the last 24 hours, and we haven't got a lot of movement everywhere else. I mean, if you look at the rest of the currency market, the cable's probably the biggest mover at the moment. We were, you know, we'd hit this is an hourly chart, so we hit some lows and we rallied, you know, about 40 or 50 pips, and then we sold off again. But the pound, as I talked to you guys yesterday about this, we are, you know, coming into a pretty big, what I consider as a support zone. This actually should go all the way back here. Looks something like this. Okay, back there, something like that. So you can see all these highs here, or excuse me, highs here, lows here. This is a what I call support zone. We already respected on the first time around. This has been drawn out for quite some time. You know, before we even got here, you know, as we were doing the A, B, C, D move, I'm like, okay, we're going to be coming right into support. We've already bounced from there once. Even if we take out new lows and we break into a slightly lower low, I'd still think that we're going to see some divergence in relative strength. So I'd be a little bit careful about being too aggressive on the short side down here. You know, if we're trading down towards 123, I'd just be a little bit more careful. Let's take a look at the euro. The euro, a very similar type of situation. I kept my orders in. You guys have known I've had my orders in for 2 weeks at this 111.50 area. I missed them the first time around when we dipped to 111.70. I was very irritated about that. As we dip down towards 111, or I was thinking we might dip back down towards the support and maybe even make it all the way to 111.20. But overnight, we haven't seen much. And, you know, the fact of the matter is we're trying to draw this out for you guys. We're trying to make a little bit of a higher low here. You can see this is, you know, a bit of a higher low than this one. So I'm going to delete this ugly drawing, and I didn't do that too well. But given that we are making some higher lows, I would be kind of careful on the short side as long as stocks are holding up. If stocks start breaking down, that's when the dollar starts to gain some, you know, gain its footing, and then you have to be a little bit more careful. But I mean, if you look at equities, equities are still holding up. We're in this triangle. It's not like we're going down yet. Matter of fact, today, I mean, we can see we're just kind of bouncing around. This is all of European trading. The S&Ps have really done nothing. So while we're still holding up well, you got to imagine that the euro is going to hold up well as well. If the S&P starts to break like this, if we start to break down like that, then you have to imagine the euro dollar is going to give you a similar price action. We're probably going to see a move back down towards 111.20. So like I said, as long as the stock market is holding up, I think you got to be a little careful with the euro dollar on the short side. Now, one of the other ways we can look at this too, if maybe you want to get a little bit of a head start, you can kind of look at it like a flag, right? So as long as we're holding this flag support, you got to be careful, right? And then, a breakdown of the flag, that's what it would look like. And actually, that's probably exactly where we'd go if we started breaking down. But in order for that to happen, I'll say it again, you probably have to have stocks moving lower at the same time. I doubt there's going to be any news today that's going to be a headline that's going to sink the euro like that. It's going to have to be equity markets showing some weakness and a correlation taking hold, right? So that's what I'd be thinking. One of the last things I want to bring up before I bring in Steve, and Steve and I can banter and talk a little bit about what's happening, is I want to talk a little bit about the yen. The yen has been a very confusing trade to a lot of people this week, myself included, because and fortunately I didn't trade the dollar yen. So I'm happy I didn't get caught on the short side. I really thought about it when we did this earlier this week when we sold off below the support. I was thinking on this rally back I was going to get short up here at 106.50. I just never did it, and I'm happy that I didn't, obviously, because I would have been squeezed. But these moves in the dollar yen have been very confusing because, technically looked like we're going to break down. Then we came back and tested the breakdown point. Then we squeezed higher, broke above resistance here, squeezed anybody who was short, got some people long. Then we reversed lower. It's like, man, I look at this dollar yen and I honestly do not know what to do with it right now. It's really difficult to gauge. It's not moving with your traditional correlations. It's not even moving with yields. And I guess you could argue, well, it's not really moving with, well, it's kind of moving with sorry, the S&P or whatever, because sorry, it's Friday and I'm tired. It's probably moving with the S&P because we're just not getting a lot of direction with the S&P at this point, which you could argue that. I mean, you could argue that that's the case. But for right now, I think what we should do, and actually what I could probably do from here, let's do this. Watch this. I don't do this often, guys. So watch this. Okay. So what we should probably be focused with the dollar, and don't worry, I'll be drawing everything here in a moment. I'll go back and redraw a lot of things that I think are important. But just to kind of every once in a while, when you're looking at your charts, you do have to clean them up. And when I look at a currency pair like what's happened with the yen this week, sometimes it's just good to start from scratch, kill all your previous drawings, go back and redraw, and maybe you can sense some clarity, because I don't have, from a fundamental perspective, there is no clarity. And from our contacts in Japan, the order flow is right now is, buying it on dips to 106 and selling rallies up to 110. And that's, the order flow that we're getting from our contacts in Japan from an exporter point of view. Does that help us in FX right now? Other than we know there's a lot of support around 106, not really. So technically, you kind of got to look at everything and go, okay, well, what am I going to do here? What would provoke me to actually be in a yen trade? And right now, it would probably be something that look like this. If we squeeze back above that resistance, that's also a 38% retracement, right? So in essence, if you squeeze past 107.50, the thought process has to be, okay, we got people squeezed out of their shorts here. It's going to continue to squeeze back up towards 108.50 if we can get past this resistance. And that's kind of the way I have to look at the dollar yen right now. It's more of that versus trying to get directional at this stage while the 106 level is holding. So anyway, just some food for thought on how I'm kind of viewing the yen right now, especially with these lows holding. So with that being said, Steve should be here. Good morning, Steve.
Hey mate, good morning.
Hey, how you doing?
Good mate.
What's going on? You ready for Friday?
Yeah, Friday hasn't been going that well so far. We've had several issues we had to tackle, but okay,
Yeah. So
it's
you
Friday.
wait. You're saying you told me that one of your animals, one of your pets, is losing all of its hair.
Yeah, but it's not only that. We had some. Don't worry about it. Anyhow,
Oh,
it's
okay,
okay. Some
but
allergic
that's
reaction. That's some allergic reaction as it seems. So it shouldn't be anything.
oh wow. I have three dogs, and we've had this one of our dogs. It's 13 years. It's our between my wife and I, we've had five dogs since we've been together 20 some odd years, and the one that's 13 years old, she for the last like 2 years we keep saying like she's not going to make it another year. But she's still kicking and she's still healthy as all get out. She can't see anything, blind as a
Yeah,
bat,
and
walks into
unfortunately,
walls and everything. But
it's very common with dogs when they grow older to get cataract. Yeah.
yeah, she can't see anything. She barks at everything, but she's still great. But I'm really dreading that day that I don't like going to the vet. I don't like going to the doctor, and I definitely don't like going to the vet. And anyway, but I'll probably be talking about her in about another year, saying, yeah, well, she's made another year. Anyway, as far as the currency market goes, I wish there was more. It was a really quiet night overnight. It's a quiet night overnight when if you can go to the live stream here and you can go through basic technical at this time in the morning, and you might see uh like maybe 10 to 5 to 10 to 12 charts being updated, and that's usually from me looking at charts and I go, okay, here's you guys got to keep an eye on this, you got to keep an eye on that, and then you can go through the live stream at this moment, usually at this time of the day, and you can get a bunch of updated charts and updated analysis. When I'm sitting there looking at everything and I don't update a lot, that means that nothing's happened, and we've really seen a lot of tight trading ranges this Friday going into the weekend. And I don't know if we're going to expect a lot of movement today either, because there's not a lot of data coming out today as far as economic data that I think is going to be moving the market. We have, we do have PCE, some inflation data, and I guess to be fair, a couple of Fed governors talked about the importance of inflation data coming up moving forward. But is that what the market's focused on right now? I don't think it is. So, are we going to get some explosive movements here with PCE coming out here in a moment? Which, by the way, I'll just sit here with us. If you want to rattle off the data, Steve.
Yeah, mate. I'm here. Yeah, we have core PC, as you said, use personal income, and use consumption. That's the data points we have. You want me to put up the screen?
It should be out now.
0.1 core PC versus 0.0 expected. US personal income minus 4.2 versus minus 6 expected, and consumption lower at 8.2 versus 9 expected. Previous ones were like, previous one was minus 12.6. So, a rebound was clearly expected.
Yeah, so a little bit of dollar weakness coming through, but I mean, what's it really? I mean, the euro popped up a little bit, but I mean, is this gonna be a big market mover? No, it's probably not. So whatever you're seeing right now, it's probably gonna revert back. So the euros, popped up, to 24. We're probably gonna back right back off to the teens. So anyway, not a lot of not a lot of movement is happening at this point. And I can't imagine it's going to be too exciting going into, like I said, Friday. The one thing that I'm gonna just keep everybody's radar right here on the dollar Canadian. Just watch the dollar. Whoops, you can see I have a couple alarms set up. A move below 136.35 would be a bearish event, and a move above 136.65 would be a bullish event. And I'll be looking for, a breakout, either or, going into today. Like I said, with crude oil as weak as it is, my expectation would be that we're going to be breaking higher. But with, if stocks continue to hold up, and the chances of that really, breaking higher today necessarily doesn't seem like super likely. But it doesn't mean that we won't eventually make a move. Steve, are you here and available?
Yeah, mate.
If not,
I am.
Oh, you are. Okay. All right. I just wanted to make sure that you were here and available, and I just want to wish everybody a great weekend. I want to thank everybody for being, for supporting us. And I'm going to let Steve take over so he can go over some of the other charts. But if you are not part of Forex Analytics, make sure you give us a try. It's only $1 for 10 days. Dale's talked about that. But also visit our webinar sponsor, Forest Park FX. They'll help you as a trader, retail trader, be able to find a broker that's best suited for your needs, so you can get either cashback rebates, or you could actually be part of the reimbursement program, where you could possibly get Forex Analytics for free, be part of this community, through your trading. So you can contact them on Skype and email right here from our website on the reimbursement program. So Steve, Coach, I'm going to pass it over to you.
Have a good weekend, Blake.
Thank you, mate. Have a good weekend. And
you guys have a great weekend as well. And be safe. Take care from wherever you're at. And I'll see you on the week ahead video on Sunday.
Inshallah.
See you guys.
All right.
Bye-bye, mate. Hey, Dale.
Hi, Steve. How are you, buddy?
I'm good. Quite a lot of stuff we're trying to tackle today.
Yeah.
Kindly, I need to know how to use your signals and analysis. Do you have any tutorial? Yes, we do have tutorial on YouTube, and actually we are about to upload a new one because we've made some changes on the site, but the main service hasn't really changed. Regardless, we're going to be uploading a new one within a week or so. We've almost done, shooting it. We just have to edit and upload it. Has the dog been checking leishmaniasis common in Greece and the Mediterranean? No, I don't have dogs. I have cats. And, one of them has like some allergic dermatitis. Who knows from what? Thank you, Angela. Okay, so.
I think your cat's been trading the yen.
You think so, huh?
Yeah, so it's just it's a nervous reaction.
I would assume I would assume that I've taught her better than that.
All right. So she's in the Swiss.
Speaking of the yen, nothing really happening here. I mean, if you zoom in on the 4 hour and below, you can start envisioning that several things might be happening, but it gives you good perspective. If you zoom out on the daily chart, where you realize that more or less nothing is happening. So it is what it is. Now, clearly USD yen has completely stopped following what's happening with risk. Is it following what's happening with yields? Yeah, a lot more closely. And to be honest, that was always the case. I mean, the USD yen was closely following whatever was happening with yields. It's just what has changed is that yields used to follow very closely what was happening with risk, which isn't the case anymore. We've seen those two decouple at a huge extent. At some point, for several years they were trading in lockstep, but that's not the case anymore. Now, clearly, yields, in my opinion, are in a bearish consolidation. Yeah, I mean, it looks to me like they want to be pushing lower at least once more. Now, logic says that this should normally be happening while we would be seeing stock markets, roll over
Risk
and
off, yeah.
push lower and produce some risk off. So we haven't seen any follow through. I mean, we've clearly stalled at that 3170 area. If we're talking about the S&P, if we actually go on the 4-hour chart, here it is. So if we go on the 4-hour chart, we've clearly been rejected from there, but there is no real follow through yet. So assuming what kind of formation we have here is a technical formation is extremely hard, because I can come up with both bearish and bullish interpretations. I can also come up with both a bearish interpretation that is only short-term bearish, for another push towards like 2870, and a lot more bearish interpretation. So the price action has to become more clear, which that's not the case so far. So for the time being, we can only give some like very basic guidelines. Of course, if you want to use, fundamentals as your compass, clearly the risk reward favors short positions. I mean, no matter how you look at it, you want to look at it from the perspective of expected earnings. They've plummeted, and they're not even looking like their earnings expectations are rebounding. So there is a huge gap that needs to be filled there. The only two ways that this gap can be filled is either by the market starting to immediately reprice earnings expectations a lot higher, which doesn't seem like being the case. There are still a lot of factors that affect probable earning expectations that haven't gone away, like, for example, coronavirus, because as we said, coronavirus can keep affecting the economy just by being there, even if the economy doesn't go in lockdown again. Or, of course, stock markets can depreciate, strongly. So, this is the only two ways that this gap can be filled. Anyhow, clearly 3160 roughly is a key area of resistance. To the downside, as I've said, 2970, a daily close below 2970 is going to be required for me to feel a lot more comfortable that there is more downside that is opening up. Until that happens, it can go either way. So you decide on that. I'm still short, by the way, right? So my money is still on the short side. Nothing has changed having to do with that. but it's not a slam dunk, and the only reason it's not a slam dunk is because of the huge amounts of artificial liquidity support that are being injected in the market, literally, with almost no exception, every single day. Now, as long as the stock markets and the risk assets are quote unquote confused, as they seem to be during the past few days, the rest of the risk assets are going to be following the same type of behavior. And clearly FX, especially the pairs that are traditionally well correlated inversely or directly with risk, are also going to be in consolidations. One example is the Aussie. So here's the Aussie consolidating. Admittedly, this consolidation, if you look this chart in isolation, makes it a lot more probable that you're going to see a continuation to the upside than anything else, because we've had a clear rebound higher, and so far this consolidation seems to be just uh, taking a breather after a decent move higher. Usually those get resolved in the direction of the previous move, which is in this case higher. Sorry, this is the Kiwi, by the way. But if you look at the Aussie, the picture is very, very similar. So, it doesn't really matter that it wasn't the Aussie and it was the Kiwi, because here is the Aussie. So, perhaps a triangle. Anyhow, some similar type of consolidation taking place here. Not the exact type of consolidation we're seeing the Kiwi, but nevertheless, it's still a horizontal consolidation, a very decent chance that this gets resolved to the upside. Of course, that would imply that this recent consolidation in stock indices is going to be resolved by seeing one more leg to the upside, which isn't unlikely. Now, having to do with USD CAD, Blake already mentioned it. If you remember, I've kept saying again and again that if you want to be short one of the commodity currencies against the dollar, that should definitely be the USD CAD. USD CAD gives you the ability to be long the dollar against the Canadian, and clearly the Canadian is underperforming like the Aussie, the Kiwi, the Norwegian kroner, etc. So I'm still seeing this large descending channel. We've broken through this little triangle that we had here. Next area of resistance is this channel trendline resistance. Above that, I think that we open up quite a lot more upside. So keep that in mind if you want to be long the dollar against the commodity currency. USD CAD should be your preferred choice. Having to do with Euro USD and the cable, both of them depreciating. So far, this can be viewed as correcting the recent gains, because as you see, so far this push to the downside has been in a very orderly fashion within channels. Here's the Euro USD channel. Admittedly, the cable channel is a little bit steeper than the one the Euro USD has produced, but worth noting here that we found a recent low at equality of the first leg lower to the second leg lower. So that usually is a very decent signal that something is probably corrective. Now, that there is no guarantee in the markets. I'm just telling you that usually it's a good sign that we might have seen a low. So if the bulls keep defending this 123.28 level, I guess it makes sense being long against it from a risk reward perspective as well. Now, crude, gold, silver, every day you're asking about those. We were talking about consolidations. So here's another one from gold. Let's go down to the 4-hour chart so you can see it more clearly. So here it is on the 4-hour chart. We broke above this channel. We seem to be developing. I mean, gold has developed so many of those during the past few months, so many of those type of consolidations. And, the vast majority of them have been resolved to the upside. And there are your next upside targets, right? 1791, 127% extension of this recent pullback, and 161.8 at 1824, the 161.8% extension of this recent pullback. Needless to say that, from this point on, this 1735 horizontal support area should be considered, an important support level, and above it, there is absolutely no reason to fight the trend and try to be short. Now, silver, oppositely from gold, hasn't broken above the equivalent channel, but it's testing resistance once again. From a risk reward perspective, makes sense being short here. Not that I would want to be short. I'm just saying that it makes sense because you can risk like very little to hope for another attack of this channel's trendline support. Personally, I still think the path of least resistance remains to the upside, so I still believe that there is a very high probability that silver is going to follow gold higher, is going to break above this channel, and is going to push towards the next area of resistance, which is at $19. Now, having to do with crude oil. Crude oil clearly got rejected from the 161.8% extension of this recent pullback. Now, it's interesting because we had pinpointed that in advance. If you look at the daily, that was also the 161.8% extension of this last leg lower, the last bearish leg lower. So, nice confluence of resistances that got it rejected from there. We have now broken through this steep ascending channel, which tells me that there is a very high probability that there's going to be at least temporarily more weakness before we can see more strength. Now, yesterday's rebound was, let's fib it. So yesterday's rebound was at the 50% fib, which is, anything between the 38.2 and the 61.8 is considered like an excellent textbook area, to see a rejection. And that's what we saw there. I mean, we just went over the 50% fib, and now we seem to be rolling over once again. So I have to admit that, from a risk reward perspective, at least looking for one more leg lower with 33.75 being the next downside support, and the next after that being just below 32, that low over there. I think it's it's a rather appealing looking chart and opportunity. So if you're interested in trading crude, that's what I see here, and I do think that we should, at least after that huge move higher, see at least a 3 wave correction lower, and we might just be starting the third one down. And of course it might even prove to be a much more complex correction, which might take us a lot lower than that. Angela says cats can get it too. Steep on Greece and the men's sandflies. Yeah, deadlift not treated, usually accompanied by loss of appetite. Yeah, so far we don't have such signals. Thank you. Although keep in mind, Angela, that we live in an apartment at the 4th floor, and my cats don't come in contact, with the outside environment. So I assume it's a rather low probability scenario. But yeah, the vet checked her. She says that she looks in good health. So, she thinks that it should pass. Of course, we'll monitor closely, and let's hope it's not something, worse than that. Steve, how do you trade these channels? Channels are, probably the best formations to give you a general direction and show you changes in trend. So, trend lines and channels, I use them, to indicate, where the trend is, both short term and long term. So I think that channels are like the second most basic tool after, trend lines. And so in essence, if you ask me, the most basic technical analysis tools are fibs, trend lines, channels. So if I had to use like just 3 of them, I mean, those are the ones you would use. Neil, I already covered both the euro and the pound, actually, both euro USD, if that's what you're talking about, and the pound. I already covered them.
Want to hear my 61.8 poem again?
Go ahead. Why not?
61.8. Could you feel it resonate? And then when you think you know the tricks, it stretches to 78.6.
It's good. It's indeed good. Now,
I don't have
you
anything
said,
for it. Nothing rhymed with 30.
Neil asks, yes, with channel as an example. You wanted an example of Euro USD and the channel? There you go. This is the daily chart of the Euro USD. Look at the purple channel here.
Yeah.
Actually, if you see, I was actually monitoring 2 channels. The one that has the 2 intermittent trend lines, right? And the one that has the 2 solid trend lines. And as you see, the one with the solid trend lines is the one that rejected price action once again at the 10th of June. So, just like 15 days ago. So this is another example of channel. So for example, once we break, and if we break through this channel, that's going to be another indication that something is changing here with the trend, because the trend clearly remained lower. But we initially broke through this one, which was a little bit steeper. So a first indication that something is changing in the Euro USD. Now, if we break through the second one as well, that's going to be a second indication that something is changing here with the Euro USD trend. So
well, your dotted line was certainly present because you were talking about it once we got through it. That was a pretty good trade.
Yeah. So this is a general way in which you can use channels to give you signals that something is changing. Because keep in mind that no matter what kind of trading you do, even people that like to trade counter trend, and a lot of people like to trade counter trend. Many of them, unfortunately, to their peril, because many of them are doing that because we are psychologically wired to want to trade counter trend, because we're psychologically wired to want to sell something after it's gone up and to want to buy something after it's gone down. Unfortunately, if you try to do that when something is clearly trending, then in the vast majority of the cases, you're going to be losing more money than making. And a lot of people are actually, failing in trading the markets exactly because of that fundamental psychological bias that we have. So it's a viable tactic to sell something that has gone up and to buy something that has gone down if you are range bound and there is no real trend and you're moving horizontally more or less. But it's a very, very wrong thing to do if something is trending. And I can give you many, many examples of things that are trending. For example, I have no doubt whatsoever, I'm going to give you one of the most extreme examples. I have no doubt whatsoever that there are tons and tons of people that have lost their trading accounts because they were trying to short the move higher that started in 2008 in the USD Turkish lira. Now, you can understand why they lost their money, right? Because in essence, this is a trend that has been ongoing for 12 years now, with very, very few pullbacks that are usually short-lived. So that's why I said, it's important. So even if you would like to trade counter trend, it's important to know where the trend is and if there is a trend, because you don't really want to trade counter trend when there is a clear trend. Let me go back to the question. What do you think of USD ZAR for a breakout higher from its dead cat bounce? USD looks very likely as USD Turkish lira looks at the moment. So probably you mean the opposite, because we've already had a pullback from the highs. Here's an example of the USD Turkish lira. Quite a nice move lower after breaking through an ascending wedge. I see a consolidation here, which I give it a very high probability scenario that's going to produce at least one more leg lower before higher, right? And I assume the same picture we'll find if we have a look at the USD ZAR. Yeah. So, not very easy, but I would assume that we might have, at least one more leg lower before higher here. Okay. How about CAD yen? Listen, I already said that the Canadian dollar is, very weak in comparison to the rest of the commodity currencies. And if you have a look at the CAD yen, let me find it first. Here it is. You'll see that you can clearly see this on the chart. Let me go to the 4-hour chart so you can see better. Also keep in mind that if my theory that crude should suffer more in the short term, keep in mind that that will also keep more pressure on the Canadian dollar. So look what I'm seeing here. I see one pullback, I see a triangle, and that tells me that there should be at least one more leg lower in the CAD yen. So that's what I think about CAD yen. I think that it's probably about to make another move to the downside. Okay. So that's what I think about it. Now, okay. My pleasure. Short pound Aussie on a break of 180? Question mark. Let's have a look at it. So let's have a look at it on the 4-hour chart to begin with. So pound Aussie, you said. Here it is. Listen, there is absolutely no evidence that pound Aussie has turned higher, right? We remain in a downtrend since March 19th. Every rebound is usually getting rejected quite fast. This is another case here. I mean, we got that rebound and we got rejected at the first area of resistance here at 181, like 30. Now, clearly, the downside momentum has waned. So that's one thing to notice, that, we've already seen a lot of downside and momentum is already waning. So, that would make me somewhat skeptical. On the other hand, the downtrend hasn't broken in any case. So, yeah, the path of least resistance against 180, 130 remains lower. Obviously, on a breakdown from the previous low, you should expect another extension higher. Why not towards 175.70, which is the next downside area of support. So yeah, that's the case. I mean, until proven otherwise, that's the case. Of course, keep in mind if you see any move, if you see like the indices rolling over or whatever, you don't want to be in the short side of any of these crosses like Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi. If you see like the market going in a risk off mood and you're short these pairs, yet like cover your positions because they have an excellent inverse correlation with risk. So when a risk is on, they keep dropping lower. When a risk is off, they rebound, and they can actually rebound quite viciously. I mean, these pairs can actually create like rebounds of like 500 pips within half a day, and not even blink. So keep that in mind. Here's the pound kiwi. Also, here's another example for our friend that was asking about channels. There is a nice descending channel that so far defines the downtrend, right? Undeniably. Very nice channel. The market has already respected it multiple times. So, your first indication, your first hard evidence that something might be changing in this trend would be if and when you eventually see a break from the trend line resistance. That's going to be a strong indication that, this big move lower, is over, at least temporarily, and, you should see an extension to the upside. Until that happens, the safe way to go is, assume that we remain in the downtrend and, either trade it short and sell rebounds, or if you really just want to be buying, not buy until you see a breakout from the channel. So at least you'll have, stronger evidence that you'll be in the right side of the market. Okay, let me see what other questions I missed. Dale, do we have an interview today, by the way?
Yes, and he's
Oh,
here.
we do.
Yeah.
Ah, okay. Sorry.
That's okay.
Yeah.
Right on time.
Okay. So then, have a lovely weekend. See you all on Monday. Sorry we can't cover all questions every day. I do my best.
You do a great job, Steve. Another good week of covering the board for everyone. Thank you very much, man.
My pleasure. Enjoy.
Okay, so Mike, I'm going to get you set up as a panelist. I'm looking forward to talking to you. The company you work for, Dr. Martin Weiss, wrote a book that really had impact on my life in the 70s. I want to talk to you about it. So I'm promoting you to panelist now. And I'm going to unmute you. Welcome to Face, Mike.
Yeah, glad to be here. You can hear me okay, correct?
Yeah, loud and clear. Did you want to share your screen? You have anything that you want to show?
Let's see. I can, we can chat a little bit here. I don't mind throwing up a bond chart or talk a little bit about interest rates and so on.
All right, you know how to use Zoom. There's a green share box there.
I also made you a co-host in case you want to share your camera as well. So, share your screen camera, whatever you feel comfortable
So you
with.
show your pandemic haircut.
Let's see. Fortunately, when they first reopened the places down here, I was able to sneak a haircut in, so I'm not in too bad shape.
Okay, I am. I look like Ringo Starr. Anyway, Mike, really nice to meet you. And, I'm familiar with Dr. Martin Weiss from many years ago, around the beginning of my career. So I'm interested, before we get to the charts, on what your journey was like to get to where you are at point B. How did you break into the industry? And tell us a little bit about your background.
Sure, absolutely. I find I've been working at Weiss for a long time, since 2001, and I've found that about half the people I've worked with over the years in the investment publishing and advisory business come up from the traditional broker channel, or they're money managers, they're handling clients and so on. Then about half come up from the journalism side, and I look at it as you either know the writing and you learn the finance, or you know the finance and you learn the writing and communication. And I'm in the communication camp. I actually and when I was in Boston University in the mid 1990s, I started working for Bloomberg News, their bureau in Boston there, and that was kind of my first exposure to the financial markets. Just writing brief stories and things like that.
Were you a journalism major at Boston U?
Yes, I was. I was an English and journalism double major, so I stayed up there during my summers and did some extra classes and so on. So that was where I kind of got directly exposed to the market. I mean, my father, for years and years before that, had been talking about the markets. I remember him drawing hand charts in the 80s and different things and so on. So
me too, son.
So in any event, I mean, I didn't know exactly what they were when I was 10, but it was fun to look at. In any event, so I picked it up there, and then after I graduated, I went to work for Bankrate.com, kind of following and writing about the mortgage markets, housing industry, and so on. And then I transitioned over to Weiss again in 2001, and I've worn a lot of hats there, whether it's writing, editing, helping trade our premium or newsletter services, and so on. Done a little bit of everything there, and it's one of those things where there's always something new going on. There's always something different to talk about. And it's a business and industry that's always constantly changing given what the markets do. So even after all these years, I still find it fascinating and do my best to help people navigate things, especially when we have years like this where it is truly, truly unpredictable and unforeseeable in so many ways.
Yeah, so the jigsaw puzzle we guys like us do not have to do brain exercises to, stay alert and avoid what happens later in life. I want to ask you about a book I read that Martin Weiss wrote in the 70s. You probably, well, let's see if you heard of it. The Great Money Panic.
Yes, I have heard of it. We have actually in our building, which of course we're all working remotely right now, but we do have sort of a library, a storage room that has all of the old things that Martin's published over the years, and I have gone through them, absolutely.
Did you read that book?
I've read part of it, not the whole thing,
All right.
cover to
All
cover.
right. All right. So it's interesting. He describes in that book basically that there's so much debt that rates go up not because of economic growth, but they go up because there's not enough demand for the paper, and rolling things over creates a spike in rates, which we were beginning to see in a small way in the Fed funds market. I think about back in the fall,
Mm-hmm.
and what happens then is that as rates go up, it creates a deflationary environment where people are selling everything to gain liquidity, including the kitchen sink. And I think he was talking about rates going up to 20, which they did under Volcker
Mm-hmm.
after he wrote the book. And I'm curious if you think that that could ever happen with the role the Fed has been playing, especially on this last foray where they came in to support both the corporate and junk bond markets. And have they taken those markets away from us as traders and investors and nationalize them? What do
Sure.
you
I mean,
think?
I have a couple thoughts on that. I think when it comes to credit sensitive markets, junk and to a lesser degree investment grade and so on, I think that those markets, we're still going to see if the fundamentals deteriorate, if the credit fundamentals deteriorate going forward, whether it's because of what's happening with COVID or this sort of dragging out of this this downturn and so on. I think that those markets can and likely will still get away from the Fed to some degree. When it comes to the government market, I've been for quite some time, a number of months, a few quarters now, really in sort of the disinflation, recession, structural, demographic camp for lower interest rates. I think that if you look at the interest rate markets, you go back to 2018, late 2018, that's when interest rates peaked and the curve started to flatten long before anybody heard of the coronavirus. And I think a lot of it was a turn in the economic and credit cycle that began back then. You can see it in a number of different ways. I mean, that's when I call them the boring sectors, things like utilities started to outperform the exciting ones, financials lagged, curve flat, and all this stuff was going on before anybody heard of the virus. And that only kind of accelerated and amplified trends that were already in place. So, barring some, huge inflationary or growth shock, if I'm underestimating the magnitude of, or if we do get this theoretical V-shaped recovery, I'm still in the lower for longer camp. And when I look at the Fed talking about, I jokingly call it NERP forever or ZERP forever, excuse me. If we're in this environment where they're saying we're not going to raise the funds rate, even if the economy gets better, and so on and so forth. I mean, last cycle, interest rates stayed pegged near zero for 7+ years or around that time. What's going to happen in this cycle where arguably the economic news is worse? Plus, we still have the aging population, the structural sort of loss of productivity, and so on. So, in that environment, I think that interest rates, if anything, at the long end especially, are going to be falling back towards zero over the next year or so.
Okay, interesting. A lot of people forget that we were already close or in a manufacturing recession prior to COVID, and that the consumer was really the engine. It usually, 70% of the economy, but the consumer was still doing well. After this government stimulus money that's being sent out to give people more money than they would make if they were employed, and stimulus money that, I don't know about you, I never received it, but plenty of dead people have. So I'm thinking that I'm thinking that the only way for me to get it is to will it to somebody. So
yeah, we've got dead people getting stimulus checks and zombie corporations getting Fed help. So it's kind of works all around.
All right, so we're looking at the note chart, the 10-year, right? That's what you have
This
up
is
here?
This is the long bond
30?
here. But
Oh,
yeah.
okay. All right. So, when the Fed came in, I think that was the biggest sell-off that I've seen in bonds in compressed time ever from the high.
Yeah.
And I'm wondering, we're right against what's that blue moving average that you have right up there that we're
We've got the
knocking
50, and
against?
that's the 50 there here. So
Okay.
50
So
and
if we
200.
break out over that, you think there's a shot for us to test at highs? And will that do you think that'll happen in a risk off environment, or that these rates will continue to support um, equities and other asset classes?
Sure. I'm more in the sort of negative camp on risk and the economic backdrop here. I think that obviously we've had the initial big risk on move. Fed comes in, does its buying and backstopping of all these different asset classes, including junk and so on. And that, gave us a decent rally. But when you look at something like, flip from a price to a yield basis, I mean, the rally in yields off the low really was a lot more subdued than what we saw on things like equities. And now, whether you're talking about fives or tens, we're really kind of back to those March lows. I mean, the 5-year yield at around 31, 32 basis points. That's essentially where we were at the middle of the March panic. And
Right.
you move to 30s, we popped up to, what was it, about 175, somewhere in that neighborhood. And here we are back at 140. I think you're seeing rallies in interest rates are not anywhere near as vigorous as rallies in equities. And that, again, that was the case even pre-COVID. I mean, this being a 30-year yield chart, you can see that the peak was all the way back in November 2018. And even as the equity market was, in terms of the S&P, was making marginal new highs, you had a lot of sectors that weren't participating in sort of non-confirmations there. And clearly we saw it in the interest rate market as well. So I think I look at our interest rate environment in the U.S. and I see a lot of similarities to what already has befallen Japan and Europe and so on. And again, it's that sort of ZERP forever, and as much as the Fed might protest, maybe eventually NERP. I mean, we've seen.
Yeah, I was going to ask you if you thought we were going to go there.
I
What
think
do you think would take us there? Bear market, another 30% lower in equities. It seems like that's a major focus for the Fed and the U.S. government as far as tax receipts and confidence. You think weakness in equities would take us there to
Yeah,
negative
absolutely.
rates?
I think if you look at again, the risk sentiment has been supported by all the things the Fed did in late March and early April and so on. But really, what the Fed itself will tell you it's trying to do is build a bridge. It's trying to just kind of hold things together for a few months while the underlying economy gets better. Main Street gets back to work and so on. But the problem is, the longer that this COVID situation drags out, the more you have lenders kind of tightening credit behind the scenes, especially for smaller credits and so on. That is really a negative or restraining factor on growth. So if the real economic news begins to worsen, which is kind of what we're seeing again to some degree, that bridge is going to end. That bridge is going to end in the water. It's not going to get you to the other shoreline. So I think that's what we're starting to deal with in the equity markets. You're starting to see some questioning of whether this bridge is going anywhere. So if that truly accelerates to the downside, if we lose that risk on sentiment, you see spreads widen again and so on, I think people are going to say, what's the next logical step? Probably what's going to happen first before we go into NERP territory is going to be some form of yield curve control. The Fed's going to try and mirror what's happened.
They'd like to have it steepen.
Yeah, and I don't know where exactly they're going to try and peg things. I mean, we've essentially had yield curve control in the fives. I mean, the range there is only a few basis points over the last several weeks. Tens are back in that mid 65, 70 range, and 30s up again, where we talked about earlier. We've seen the Fed try and effectively or see the market kind of preemptively pricing for some form of yield curve control, in my opinion. But I think that again, they're going to have a hard time keeping the curve steeper if the economic news is worsening. I think that a lot of traders, rightfully so, are going to say, look, I can still get 140 or 130 or whatever on the long bond. I'm going to buy that, and I'm going to see if this thing heads back to new lows. Because if the growth and inflation data continues to look lousy and there's no prospect for a V-shaped recovery, then I think you buy the medium to long end of the curve, and you just stay long there for some capital gains potential.
Mike, does currency and the dollar play a role in your analysis for where rates are going? And if you have a view, what would that be dollar-wise?
Sure. I mean, I think clearly, if you look just at the dollar index and what happened here in that March-April timeframe, I mean, the spike, the huge rally in the dollar was all part of the risk-off trade, and the Fed has successfully, up until a couple weeks ago, tamped that down. I think, I'm definitely keeping an eye on it because we've seen tentative stabilization, dollar index 96, 96 and a half, and so on. We made a higher low there. If we take out these recent this sort of capping area that you've had here at around 97.67, 97.70, that's going to be another risk off signal. So I think that in this situation, we're definitely going to have to keep an eye on the dollar as well. And I would also add too, if you look at, or what I find very interesting is the gold market. I mean, I'm not a traditional gold bug. I always say I'm a generalist. There's times when I like gold. There's times when I hate it. There's times when I don't really care what it's doing because there's better opportunities elsewhere. But certainly I've been, bullish on gold since late half or back half of 2018. And I'm pretty encouraged with the constructive action there too. I mean, I think that's still telling you to some degree that even with equities strong, you're still getting, buying of safe haven assets and some concern about what the outlook is for the economy overall. And I think the gold market is kind of telling you investors do want protection from less than optimal economic outlooks, and also from money printing. So that's another area that I think is pretty.
Don't you think it's a little crowded by now, Mike? And we're starting to see some negative divergences in gold up here at new highs, and the mining shares are not confirming this new high in physical gold.
That's a very interesting thing you pointed out there, and I can interpret it two ways. I mean, the people that we talk to and the people that are in the Safe Money Report newsletter and so on, I'm not really trading the very short term. It's more of an intermediate to long term type environment that I'm looking for. So I think in the short term, yes, you have some issues with gold and so on. But when I think about, okay, what's the potential for more upside in gold equities, whether it's juniors or senior miners and so on, I mean, the metal itself has looked a little bit stronger and is much closer, I think, to its old highs than many of the mining shares. And I think that if you just turn on CNBC, I mean, you hear about technology stocks 100 times an hour. Are they really talking about gold? Is Main Street all in, so to speak, on gold miners the way they might have been back in 2010, 2011? I don't pick up on that. So I think there's probably, if anything, some catch up coming in terms of, if Main Street, if more money moves from Apple to Newmont or what have you, and you see people realize what's going on there and the potential, I think that is what might lead to kind of a blow off or late term move, but I don't think we're there yet.
Okay, yeah. So the market capitalization of all the gold miners is probably equal to Amazon, or not, or
Yeah.
a tenth of Amazon, right?
Yeah,
I mean, it's a lot of money flow.
A lot of times people just want to talk about, I jokingly call them the S&P 5, because they're ignoring the other 495 or so stocks. It's all about Amazon and Facebook and Apple and and so on. But a lot of those other, if even a portion of that money starts looking at the returns you've seen in miners and say, hey, maybe this is something to be interested in, that's going to be an interesting next leg up for this, in my opinion.
Okay, I'd like to switch gears to what else rates are very important in, and that would be the real estate market. And I'd like to start with, did you think in 2009, after the housing crisis and the Great Recession, I don't know if it was great for you, um, that we would see values take out the highs, not throughout the country, but definitely in certain markets, we surpassed the 2008 bubble highs. Did you think that was possible? And what's your view on real estate with what's going on here, and a lot of people going to programs to not have to pay their mortgages for a while, forbearance? What's your view on really probably the most important investment most people have in this country?
Sure. I mean, coming out of the housing downturn, we were heading into it, we were very aggressive in warning about it. I mean, given my background in mortgages and in real estate and just following the interest rate markets pretty closely, I mean, I saw, and for that matter, living down here in South Florida, where the mania was, as bad, if not worse, than what you saw in places like Las Vegas and so on. It really gave you a firsthand window into what was going on. And after, I want to say maybe circa 2010, you had the huge rally, you had the crash. I sort of internally, I kind of was talking with people. I said, I think the real estate market's just going to move off the front pages. It's going to be sitting there. It's not going to be very exciting. Nobody's going to be flipping houses anymore. It's just going to go back to what it always was you can buy a house to put a roof over your head. Then I think what started to happen a couple of years later is we saw, as a result of the QE programs and everything else, domestically and abroad, we saw enormous amounts of asset inflation, generalized asset inflation. Housing is obviously part of it. A lot of homes were snapped up by big funds to turn around and use them as rentals. A lot of money was going in on almost an institutional money coming in to buy to rent and generate income from that. But we saw commercial real estate values soaring. We saw obviously stocks and higher risk bonds and so on. And even I pulled a lot of examples for a book I was working on everything from artwork to high-end booze to baseball cards, you name it. So it was really, I think what happened in housing was more of this generalized asset inflation environment. And you can see that because even as prices have been very strong in many markets, you look at the absolute level of home sales, it's nowhere near what we had in this country at the peak of the bubble. In home ownership rates have gone up, but they're really kind of in the same range they were in the mid 1990s. So I think you've seen the select few or the smaller group of people that can afford a house at inflated values and can qualify for a mortgage and so on, are experiencing generalized asset inflation. They've done great, but you have a lot of people, especially in sort of the millennial or Gen Z bracket, that they're sitting here staring at, they're in apartments staring at the value of houses and saying, how the heck am I ever going to get into one of these, especially given some of the overhangs and things like student debt and so on. So
is there hope for them? Can prices, if we end up with risk off and the economy heading into recession in a few years, could those values decline just as fast as they went up?
I definitely think we're going to see values stabilizing and declining in some markets, especially the highest end ones. And you're already seeing some evidence in places like New York City and so on, even before the COVID news, where you've seen supply going up, you've seen asking prices start to come down. Nothing like what we saw in 2007, 2008 to that degree, but it is stalling out in many of these markets. And I would argue you'd see the same thing in places like the greater San Francisco area. I mean, some of the appreciation there. I remember giving a presentation in 2018 and looking at some local real estate statistics for the Bay Area. And I think I computed that they were going up about $524 an hour or something like, or excuse me, it was an hour. And then that worked out to a wage. You could basically sit on your couch playing Xbox and eating Cheetos and make more on your home than you would if you were actually doing something. It worked out to something like $16 or $17 an hour. So that kind of appreciation just isn't sustainable. And I think that's what we're seeing now, where you're kind of hitting a wall in some of these markets, again, especially at the higher end.
Okay. And do you think that the great money panic could happen?
I think that we've already had a taste of it in again, not necessarily government bond market, but more the high yield and even investment grade market to some degree, as a result of what companies did pre-COVID. I mean, let's be honest. If you look at the last cycle, where were most of the debt excesses? Where was the greatest debt growth? Where was the biggest risk taking, and so on? It was in mortgages last time. This time, it's absolutely on the corporate side of the ledger. I mean, we talk about CLOs and all the junk paper that's kind of crammed into them, and takeovers at wildly inflated ratios funded by junk debt and the private equity boom and so on, and whether it's financial engineering by other companies borrowing to buy back shares and so on. That's where the excesses were in this cycle. So I think you're going to have an issue. I mean, the Fed, and again, the Fed has stabilized or given, the junk market a leg up and investment grade a leg up or so, just by intervening for the first time there in its history.
But I heard they didn't spend a dollar. It was all jawboning that rallied the market. Is that correct?
Yeah, almost all of it is. If you look at they did purchase some, I forget the exact total, but in terms of hundreds of millions or a couple $1 billion worth of ETFs and so on. But they haven't, mostly, the impact in prices and spreads relative to the actual dollars spent or used to this point, it's been a lot of bang for very little buck. But I think that, again, if the economic data is starting to roll over, we're getting a taste of that now. If that gets worse, the Fed's going to have to be in there a lot more aggressively than they have yet. People will play along, tag along, whatever you want to call it, ride the Fed's coattails. But if the cash flow issues are behind the scenes are bad and they start to get worse, you're going to see all of this roll over. And you're starting to get a taste of that if you look at some of the most economically sensitive sectors that benefited from the initial run up. I mean, this is Jets. This is the ETF that tracks all the airlines. Big run up from 12 to $22. Now it's back at 16 and a half. Cruise line, same story. So you're seeing some of that initial euphoria way off, or sort of run out a little bit, and now we're at a crossroads. And I think that's going to be really interesting for the next couple of weeks to see where things go here.
Okay, I just want to circle back to one statement you made, is that things could get away from the Fed. What should we be looking for to see if that's starting to manifest?
I think you're gonna see it. I mean, if you want, most people, if they want to just keep it simple, they can track things like this. This is the JNK, the high yield ETF, HYG,
Okay.
either of those. If you want to get a little more, a little deeper, you can go to sites like the Fred website, the St. Louis Fed website, and look at actual spread indexes, credit spreads, and see how they're behaving. Are they starting to widen out again? I mean, and we are seeing that, but it's been tentative. If we start seeing credit spreads begin to blow out and move in bigger chunks, that's when we're going to have some issues. And I think that I would keep a close eye on that. I would keep an eye on a lot of those economically sensitive sectors. Again, whether it's financials, I mean, this is the XLF. You can see it had a reversal yesterday, but then after the close, we got this news from the Fed about tying banks' hands when it comes to dividends and share buybacks because they're afraid of losses. I mean, that if you start to lose sectors like that, and we get into a situation where those are rolling over, then you've got problems, in my opinion.
Or how about just going to weissratings.com to get all this information? And now would be a good time to show your website, and the best way for people to follow you on Twitter is at Real Mike Larson. And perhaps do you have subscriptions for your service here? And it looks like you have webinars and everything. Why don't you tell us a little bit about
Yeah,
what you
sure.
do? Do
Sure.
you service retail or strictly institutional?
No, we have a couple of different business lines, and we're in Weiss Ratings. Historically, the company has been involved in bank and insurance company safety ratings, so underlying solvency issues and so on, rating them just like a larger company like S&P would, for example. But it's tailored towards a mix of individual and institutional. Then many years ago, we also got into the investment rating side of the business, where it's a different ratings model that's designed to look at the quality of stocks, ETFs, mutual funds, and so on from an investment standpoint versus rating the underlying quality of the bank's balance sheets and so on. So we do both of those. And then we also have things like newsletters and more active trading services. I'm involved with the Safe Money Report. That's our longest standing product that Martin
I
actually
remember it.
Yeah, Martin began it in the 1970s. I still have the first issue of what was then called Money and Markets. It's nicely yellowed now, but the little booklet it came with. But we've been doing the Safe Money Report for many, many years, and that's what I'm involved with. And so that's more of an investment, retail-oriented type product. But the ratings can be used by, again, an individual or institutional angle. And what people can do, it's very simple. Just from the ratings website, they want to check the underlying fundamental ratings on their stocks, for example. You type in the ticker, you can get a brief report on Johnson & Johnson or what have you, and go from there.
Wow. Okay. So, everyone, here's a great resource for interest rates and bonds and all things related to it. And Mike, I want to thank you so much for, after a long week, having some juice left in your battery to come in here and talk to us. I learned some things from you today. So again, thank you, buddy, for coming here and edifying our community and face today, Mike.
Great. It was a great opportunity, and I appreciate you inviting me.
We're going to do it again, Mike. I'll be in touch with you on Twitter, and have a great weekend. I hope you and your family remain untouched. And I really do appreciate that you came here today, and would like to have you back. What was nice about this interview is I could ask you anything and you were already ready for it. So appreciate talking to a pro.
You got it. Thank you, Dale. Take care.
All right, Mike. Okay, everyone, that's a wrap. Remember, don't just count your pips, count your blessings. Have a great weekend, everyone. And we'll see you on Monday. Adios. You're very welcome, everyone. Thanks again, Mike.
Thank you.